Before we get into the margining aspect of futures contracts, let us look very carefully at this particular slide. This gives you in a nutshell what actually happens in the case of futures contracts. How do the futures actually operate? How do they work as a forward contract, notwithstanding the daily margin transfers and marking to markets? Let us say you take a position, a long futures position at a price which is F0. Let the settlement price on day 0 be at F0 star. Therefore, if F0 is different from F0 star, the difference will be transferred to your margin account in terms of marking to market. In other words, because you are having a long position, so F0 star minus F0 will be credited to your margin account. Of course, it may be negative, it may be positive. Algebraically, it will be F0 star minus F0 that goes to your margin account, debit or credit, depending on whether it is positive or negative. Let the settlement price on day 1 be F1, then similar to what happened on day 0, F1 minus F0 star again goes to your margin account. This process continues every day until the t minus 1th day, where again we have the same situation, f t minus 1 minus f t minus 2 is again transferred to your margin account. On day 2, using the same logic, f t minus f t minus 1 goes to the margin account. So, the total transfer to the margin account during the period that you had a long position in the futures contract is obtained by adding all these figures, aggregating all these figures, which turns out to be f t minus f 0. All the intermediate figures simply cancel out. But as I mentioned earlier, when we do the final settlement, we mark the futures price at final settlement equal to the spot price prevailing on that date. Therefore, what we do is we set f t equal to s t. This is what is done by the exchange as per the settlement procedure, and this arises because of convergence of spot and futures prices on maturity, which we will talk about in a few minutes. So, f t is equal to s t is set at final settlement of the futures contract. Therefore, the aggregate margin transfers now turn out to be s t minus f 0. Now, this is a cash settlement. Let us assume that this is a cash settlement. So, this cash has been transferred, but you still do not receive the asset. So, what you do? You buy the asset physically in the market if you want to own the asset. When you buy the asset in the market, what price you are going to pay? You are going to pay the current spot price of the asset, which is s t. So, your cash flow at that point in time will be minus s t, which is what you are going to pay for purchasing the asset, and plus this figure, which is the aggregate benefit of holding the futures position. Combining these two, what do we get? Minus s t plus s t minus f 0, which is nothing but minus f 0. In other words, you have acquired the asset physically from the market at s t, but because of the profit that you have derived or because of the change in price in the futures market, you have in effect incurred a cash outflow of f naught in acquiring the asset, which is nothing but a forward, what a forward contract would have done. Now, let us move to the margining system. Now, as I mentioned, the exchanges have different tiers of operators. We have the investor at the lowest level, we have the broker, we have the clearinghouse members, and finally, to cap it all, we have the clearinghouse. Commensurate with this, we also have different types of margins. We have the margin requirement at the investor level, we have margin requirements at the broker level, and then we have margin requirement at the clearinghouse level, which is to be posted by clearinghouse members with the clearinghouse. So, margin requirement at the investor level is to be posted by the investor with his broker. Broker margin is to be posted by the broker with his trading member or the clearinghouse member, and the clearinghouse margin is to be posted by the clearinghouse member with the clearinghouse. Now, we are primarily concerned with investor margin. Investor margin comprises of two parts or two types. One is the initial margin, that is blocked by your broker when you enter into a futures trade. That is called the initial margin. The second part is called the maintenance margin, which I will come to in a few minutes. The initial margin comprises of two parts again, which is called the span margin and the exposure margin. The span margin is the basic margin. It is a margin which is both these margins are mandated by prescribed by the exchanges. Span margin is the basic margin. It is worked out by software which is known as standardized portfolio analysis of risk, SPAN software, standardized portfolio analysis of risk software, and it is based on a 99% one day value at risk exposure. It is a technical term. I shall discuss about it in detail at a later point in this course when we talk about risk measures. Value at risk is a very important concept, and it shall be given due weightage, due importance in this course. Exposure margin is an add-on margin. It is an ad hoc margin, add-on margin on the span margin to protect against some marking to market losses which may be unforeseen or which may be substantial. So, but the basic thing is, this is the minimum level of margin that must be there. Exposure margin, although it is also necessary, but this margin is a more of a cushion against mark to market fluctuations. Now, what is the difference between initial margin and maintenance margin? Initial margin, as I mentioned, is the margin that we deposit when we take up with our broker, when we take a futures position, or when a futures transaction is to be enacted. Now, with the passage of time, we may be making a profit on that position, we may be making a loss on that position. Each day, as I mentioned, on the settlement of the futures contract, marking to market takes place, and the differential amount compared to the previous closing is transferred to our margin accounts. It may so happen that if you have a long position and the prices are going down, the losses may start eating into your margin, and conversely, if you have a short position and the prices start going up, again the same thing may happen. So, if it happens that way, that the price changes of the futures are in a direction undesirable to you and they are eating into the margin, once you reach the minimum level, a certain minimum level, a certain threshold, then a margin call is made to you by your broker that please deposit some money or please close out your positions. So, that minimum level at which margin call can be initiated is called the maintenance margin, that in India is usually taken as the span margin. In other words, up to the span margin, the broker may allow you to trade, but once your margin level goes below the span margin, the broker will make a margin call to you to deposit additional funds to raise your margin. Another important thing is, once a margin call is made, usually the margin has to be topped up to the initial margin. It is not that the differential between the actual margin and the maintenance margin has to be topped up. General practice is that the margin has to be brought back up to the initial margin level. Now, this initial margin which comprises of the aggregate of span margin and exposure margin, is dependent on the value of the contract. Value of the contract is the product of the lot size and the futures price. While the lot size remains constant, futures price changes, and as a result of which the margin level also changes commensurate with the change in the futures price. Of course, in case you make profits and the amount, the balance in your margin account exceeds the level of maintenance margin, you can obviously withdraw the money. There is no problem with that. Whatever profits you make, you can withdraw the money if it is in excess of the margin requirements prescribed by your broker. Just a few words about value at risk, since I have introduced this term. Value at risk answers this question which is given in red. I am P% certain that my portfolio W loss will not exceed D over T days. Slightly technical definition. This amount of D is called the value at risk. In our case, that is in the case of span margin, T turns out to be 1 day and P% is 99%. So, we talk about value at risk at 99% for 1 day. I will briefly elaborate on this. Suppose we have a portfolio P of value, let us say 5 million, and this portfolio relates to let us say some index, let us say Nifty. This portfolio value is 5 million and relates to Nifty. Now, how do we work out the value at risk? We take an adequate number of values of Nifty based on historical data, and thereafter generate possible scenarios of what could be the possible values of Nifty for tomorrow given the value of today. We know the value of Nifty today, that is known to us. On the basis of the fluctuations that have been encountered in the historical data, we try to project various possible values of Nifty in the next day, because we are talking about 1 day value at risk. On the basis of this change in Nifty, we work out the change in value of our portfolio. Because our portfolio is moving in tandem with or moving in relation to Nifty. So, whenever Nifty changes, it is very likely that our portfolio value will also change. Therefore, on the basis of each scenario that we have generated on the value of Nifty, we generate changes in values of the portfolio. We start with the value of 5 million and whatever corresponding to changes in value of Nifty, what are the corresponding changes in value of our portfolio. We align these changes in value in descending order with the highest positive value at the top and the maximum loss at the bottom. Let us say we have 500 observations. In other words, we have 501 values of Nifty, on the basis of which we are able to generate 500 observations of the changes in value of our portfolio. We have arranged them in the following different descending order, so that the lowest value represents the maximum decline in value. Then, because we are talking about the 99% value at risk, we shall be taking the 5th worst possible loss. That means, we have the worst possible loss, the slightly better loss, the slightly even better loss, and then the 5th worst possible loss will constitute our value at risk. That is how the computation of value at risk goes. Now, obviously, if the investor is unable to honor the margin call which is made by the broker has no choice but to close out the position, and whatever the difference in price occurs on the closing out of the position is transferred to the margin account, which is then closed and given to the investor. Now, the important thing here is that these two procedures operating in tandem, marking to market and margining, are essentially able to completely eliminate the risk faced by the clearinghouse. Marking to market curtails the loss to a day's fluctuations. Margining, which captures 99% one day value at risk plus exposure margin. Please note, 99% one day value at risk is the span margin. The exposure margin is in addition to that, it is over and above the span margin. So, these two margins acting in tandem are able to completely eliminate the possibility of default at the level of the investor. Let us take an example now, how the marking to market operates. On May 8, you took a long position in 1 June IMM Swiss franc, CHF is Swiss francs, CHF contract at an opening price of $0.6350. The initial margin that you deposited was 1500, the maintenance margin is 1200. That means, if you fall below 1200, the broker will give you a margin call. So long as you remain between 1200 and 1500, you are still acceptable to the broker. And once you get a margin call, because your margin falls below 1200, you have to top it up to above 1500. The settlement prices on the 4 dates are given, and then you close out the position at 0.6365. We are required to compute the cash flows and the balance in the margin account, and we are also given, which is very important, the lot size. The contract multiple is also called the lot size, or the lot size is called the contract multiple as well, is Swiss francs 125,000 per contract. The solution is here. We enter into the trade at 0.6350 and we deposit a margin balance of 1500. On the first day, that is on the day that we enter, the same day, closing price or settlement price is 6280. That means, we have made a loss in the first day. Against the entry price of 6350, we are now at 6280. That means, we have made a loss in this particular day of the difference between 6350 and 6280. That difference, when multiplied by the lot size, which is 125,000, comes to minus 875. So, 1500 was my initial deposit with my broker. On the first day itself, I made a loss of 875, and therefore, what remains in the margin account after transfer, after marking to market, is only 625, which is below the maintenance margin, and therefore, I get a margin call. When I get a margin call, I make the necessary deposit, which, as you can see, when you add these two, which brings you up to 1500, which is the initial margin, not the maintenance margin. The next day's trading brings you a profit of 937.50, worked out similarly, 0.6355 minus 0.6280 into 125,000, which comes to 937.50. So, this is the cumulative gain, the difference of the two, and this again is transferred to your margin account, which was 1500 here. 1500 plus 937 now becomes a credit balance of 2437.50. And similarly, for the next day, you again incur a small loss, and because you incur a loss, your balance in the margin account falls, because this loss is immediately debited to your margin account at the end of the day. And finally, when you close out your position, you make a profit of 375, and you end up with a final margin balance, margin account balance, which is given by this 2562.50. You started with this much, you deposited another this amount and you made this amount of profit, which gives you this much. 1500 plus 875 plus 187.50 gives you a total balance of 2562.50, which is the amount that is available in your margin account, and which you now, since you have closed out the contract, which is free from all encumbrances. Broker margin and clearinghouse margin are very similar to what we have talked about. Broker margin is at the level of the broker, the margin that the broker maintains with the clearinghouse member, and the clearing margin is what the clearinghouse member maintains with the clearinghouse. This chart represents, this figurative representation makes very clear of how this trade of margin operates. Suppose you are a long trader, that means you have a long position in a futures contract and the futures price has increased. Then obviously having a long position in the futures contract and the price having increased, you have made a profit, and the party who was short in that particular contract has made a loss. So, because that party who is short in that particular contract transfers the amount of the loss, that is the marking to market, to his own broker, which transfers it to the clearinghouse member with whom the broker is maintaining a trading account. The clearinghouse then transfers the margin to the clearinghouse member of the party who is having the long position, which goes to his broker, and finally the amount gets credited to your margin account with your broker. The other scenario. So, the implications of margining and marking to market is the two fundamental implications are: default is restricted to 1 day's price movements, and extreme cases of default are covered by margins. So, both these things together make it risk free to trade in the futures market. There is another important consequence of margining, which has probably been the reason, or is perceived to be the reason, that has resulted in derivatives causing such major financial debacles. That is the increase in the extensive leverage that these instruments provide. Let us look at a very interesting example. Let us say you invest in 100 units of a stock at S naught at t equal to 0. Your investment is 100 S naught, and let us assume that you borrow this amount at R% per annum. You buy 100 units of a particular share at S naught at t equal to 0, and for that you borrow the amount. The amount required is obviously 100 S naught, and this amount you have borrowed at R%. Let the price of the stock rise, an arbitrary thing. Let us assume that it rises, which I shall discuss the implications at the end of this example. Let us continue with this example for the moment. Let the price of the stock rise to S naught plus 1 at t equal to 1. Let us assume that the price has increased by 1 unit. Then your profit is what? 100 into S naught plus 1 minus 100 S naught minus the cost of borrowing, that is 100 S naught into R. So, this is what you have, this is the return that you have received. Now, let us look at a different situation. Let us assume that you long future, instead of investing in the stock, you take a long position in futures, you long futures on the same stock. Let us assume that your exchange mandates or prescribes a margin of 10%. Therefore, with an investment of this much amount of money, you can long 100 units of stock, 1000 units of stock, because the margin requirement is only 10%. So, with this amount of margin, this is my margin amount, with this amount of margin I can take a position in 1000 units of stock, because my margin requirement is only 10%. Let us assume that the futures price is the theoretical futures price, which is S naught into 1 plus R, because we are talking about a single period. So, S naught e to the power R t can be, let us assume that t is small. So, we can approximate it by the first term, the simple interest term. So, S naught into 1 plus R into 1, that is S naught into 1 plus R. Let me work it out, sir. So, what I am trying to say is S naught e to the power R t is equal to S naught is approximately equal to 1 plus R t. Since t is equal to 1, so this becomes equal to S naught into 1 plus R. This is my futures price, assuming it to be the theoretical futures price. Then in this, if the price change is same, then the profit that I get is 1000, because I have got 1000 shares now, 1000 minus the interest on the margin that I have paid, that is 100 R S naught, and minus the increase due to this futures term, that is 100 S naught R. 1000 S naught R is the increase in futures term, and 100 S naught R is the interest that I paid on the margin. So, this becomes this total amount. Obviously, you can see the difference is gigantic. This is approximately around 9 times this figure. Now, the issue is, if this were so, or if this happens in every case, why doesn't it become a universal a norm or a universal law? The issue here is, you see, the point is that we are assuming an increase in price in the underlying asset. We have assumed that the stock price has increased from S naught plus 1 to S naught plus 1. We have assumed that the stock price has increased from S naught to S naught plus 1. Now, this is not necessary. The stock price is a random variable, it is a stochastic process. Therefore, the stock price at t equal to 1 is a random variable, and it is certainly not necessary that the stock price at t equal to 1 would be higher than S naught. It can be lower than S naught also, and if it is lower than S naught, then just as these profits were magnified, the losses would also be magnified. That is the implication of leverage. So, if the prices go up as is been seen in this particular situation, then obviously you make much more profit due to leveraging the stock futures. But however, if the prices were to go down, the same leverage would operate against you and you would make massive losses, gigantic losses. So, this operates both ways, and we cannot say that whether the stock price is going to increase or it is going to decrease. This issue is uncertain. It is a random variable. I reiterate, it is a random variable. It may increase, it may not increase, it may decrease. So, that is one important aspect here. The futures contract gives you a leverage, a massive leverage, by providing you a mechanism whereby you can magnify your payoff, but that magnification of the payoff may be beneficial, may be negative as well. So, that is what it is. That is why we say that is one of the reasons that leverage operates in relation leverage in relation to derivatives has been attributed to massive financial debacles. Let us take another example. Suppose that you enter into a short futures contract to sell July silver at $17.20. The size of the contract is 5,000 ounces. The initial margin is 4,000 and the maintenance margin is 3,000. The difference is 1,000. Please note this. What change in the futures price will lead to a margin call? Now, the size of the contract is 5,000 ounces. The futures price is 17.20 and the initial margin 4,000 and maintenance margin 1,000, and the position is short. The short position means that a price increase of the asset would result in a margin call rather than the price decrease. Therefore, margin call will occur when this margin goes down to below this. In other words, when the broker or the investor makes a loss of $1,000 US. So, in order that he makes a loss of $1,000 US with a contract size of 5,000 ounces, the change in price is 1000 upon 5000, that is 0.20 US dollars per ounce. But because he has a short position, this price has to rise. In other words, the futures price at which he would get a margin call is 1740. It is quite a simple problem, but it illustrates the nuances of futures pricing. Another similar example, here we have 2 July futures contracts, and buys means that he takes a long position. It takes a long position in 2 July futures contracts. Each contract is for the delivery of 15,000 pounds of a commodity. The current futures price is 160 cents per pound, and the initial margin is 6,000 per contract, and each contract is for 15,000 pounds, and the maintenance margin is 4,500 per contract. What price change would lead to a margin call? Very similar problem. The only difference here is, here we have a long position rather than a short position. The rest is more or less similar. So, size of the contract is 15,000 pounds, future price is 160, initial margin is 16,000, maintenance margin is so the difference is 1,500. In other words, a loss of 1,500 will not result in a margin call. Anything more than that will result in a margin call. Therefore, since this is a long position, therefore, a fall in price will result in a margin call. A loss of 1,500 on a contract size of 15,000 gives a price change of 0.10. So, the margin call will take place when the price falls below 1.50. This example illustrates the clearinghouse mechanisms, how the margin operates, how the marking to market operates. On a particular day, at the end of a particular day, a clearinghouse member is long 100 contracts. The settlement price is $50,000 per contract. The initial margin is 2,000 per contract. On the following day, the member becomes responsible for clearing another 20 contracts entered into at a price of 51,000. The settlement price at the end of this day comes out to be 50,200. How much does the member have to add to his margin account? So, there are 3 issues here. Number 1, the settlement price in respect of existing contracts has changed from 50,000 to 50,200. Number 2, 20 more contracts have been created and each contract has a margin of 2,000. And number 3, these 20 contracts were created at 51,000 and these contracts are now at 50,200. So, there are 3 issues that need to be handled in tandem. Let us see how we work it out. Margin credited on the original holding, that is original number of contracts for 100, the price has increased from 50,000 to 50,200. So, another credit to my margin account is 20,000. On the new contracts, how much is the margin? That is 40,000, because there are 20 new contracts, each has an initial margin of 2,000. But there has been a loss. There has been a loss on these new contracts. These new contracts were created at taken at 51,000. The price has now gone down to 50,200. That means 800 have been wiped off from each contract of these 20 contracts, that is 16,000 is a loss. So, the total amount is 40,000 plus 60,000, this is what he has to bring, less 20,000 which has been credited, which comes to 36,000. Thank you.